So I want to talk about how does Wall Street value expensive companies, and why was Uber recently temporarily worth less than Doordash? And so we know Doordash delivers mainly food, and Uber also delivers food. And of course, Uber has a massive taxi business. And it seems somewhat counterintuitive that Doordash's market capitalization is even close to Uber's. So what I want to do is I want to go together, let's go together to Yahoo Finance to compare the two companies, Uber as well as Doordash. So here on the left we have Uber, okay, this is Yahoo Finance, and on the right we have Doordash. And you can see here, if you look at the PE of both companies, that both of them are not profitable, okay? So what about looking at a price to revenue multiple then to value these companies, right? Price to revenue is here, and revenue and sales is the same thing. So what about looking at price to revenue multiples? Well, we can see here that investors are valuing Doordash at a much more expensive price to revenue multiple than they're doing so for Uber. So why is that? Well, let's go to the SEC.gov website for both companies, and let's look at the most recent quarterly press releases from both companies, okay? So what you do is you go to SEC.gov, and then you look for the most recent 8K, where they reported earnings. And it looks like this usually, and if you scroll down, there's a link to a press release that looks like this. Okay, so we've got the earnings press release for the most recent quarter for Uber here, and the same thing for Doordash. And what we're going to see that EBITDA is mentioned here a couple of times. You see EBITDA here and also down here. Okay, and I'm going to explain what EBITDA is in a second. It's crucial. Okay, but what you'll see here is that EBITDA for Uber right here is negative $161 million. It was in the quarter. EBITDA is kind of like earnings. Okay. And over here, we see that EBITDA, which is kind of like earnings, for Doordash was positive. EBITDA for Uber was minus $500 million. And EBITDA for Doordash was positive $113 million. Okay, and this is really important, and I'll explain why in a second. So this explains why Doordash, okay, why Doordash temporarily had a higher valuation than Uber, despite the fact that that Uber's revenue of $1.9 billion is 50% larger than Doordash's revenue of $1.2 billion. So what is EBITDA? What is this EBITDA thing? What does it mean? So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And it's a very good proxy for net income that does not include non-cash items like depreciation or amortization. So what I love to do is I love to look at cash earnings, meaning excluding non-cash stuff like depreciation. Because when it comes to our personal finances at home, we look at how much we're saving or making after real expenses that we used, real cash for. The same thing when you look at EBITDA, because EBITDA actually excludes non-cash stuff like depreciation and amortization, which we would almost never look at anyway for our personal finances. And so also EBITDA makes it so much easier to compare companies in different countries, because EBITDA is earnings before interest and taxes. And we know that interest rates and taxes are quite different in different countries. So let me actually go and show you a little bit more details on EBITDA. All right, so we can see here that adjusted EBITDA for Uber was negative $500 million in the most recent quarter. And adjusted EBITDA, I'm using the word adjusted for a reason, of $113 million was positive for Doordash in the most recent quarter. Okay, so why did I just throw that adjusted word at you? Like, what does all that stuff mean? Well, adjusted EBITDA is different from regular EBITDA, and I'm trying to teach this in a fun way. And there's going to be going to be a big aha moment in a second, okay? So adjusted EBITDA, okay, is quite different from regular EBITDA. And actually, if we go and we search for the word adjusted, you'll see it appears in both of these companies' press releases, right? So watch this. We go adjusted. It appears like everywhere. And the same thing over here, okay? There's over 50 instances of adjusted. There we go. 57 times and 66 times for Uber there, okay? And so you're probably wondering, what is this adjusted thing? And you know, WTF, you know, why the face? What's going on here with all these yellow highlighted adjusted EBITDAs here? It's like a bad trip. There's tons of them. They're everywhere. So you're probably thinking, Chris, just show me DoorDash's earnings so we can use a PE multiple to value the company. And stop confusing me, Chris, with all this EBITDA stuff. Well, what I'm going to do is I'm going to show you over here the income statement for DoorDash. Okay, so we'll search for income. Okay, there we go. So here's the income statement for DoorDash right here. And you could see that there's no earnings, right? So earnings is actually negative 30 cents. There's no earnings for DoorDash. And there's also no earnings for Uber. Okay, so how do we value a company that doesn't have earnings yet? Well, what we can do maybe is we can look at price to revenue multiples, but that's not enough. So we look at adjusted EBITDA, okay? And the way it works is with many publicly traded companies, they release two different types of earnings statements, okay? And they release one that has adjusted earnings and one that has non-adjusted earnings. And so the way it works is as follows, okay? So accountants, what they do is they like to look at EBITDA, okay? And this is also, when accountants look at their earnings or the financial statements, this is also what is referred to as GAAP, okay? So that stands for Generally Accepted Accounting Principles. And it's very precise. And when you look at GAAP, right, which is what accountants look at, and I'll get to the finance people in a second. When you look at GAAP, it stands for Generally Accepted Accounting Principles. And again, it's very precise and records all accounting numbers, even stuff that's not a cash expense. So let me set this up here and move on. Okay. Then we have something called adjusted, okay, adjusted EBITDA. And this is something that finance people, okay, and financial analysts love to look at. And this is what's called non-GAAP, okay? And non-GAAP doesn't include anything that's non-cash and anything that doesn't repeat every single quarter, right? And so you've got GAAP here, right? This is what the finance pros look at. GAAP here, the accounting pros, and non-GAAP is here. Everything is reversed when I look at this monitor here. Sorry. And so this is important because there are two financial statements released, okay, in most quarterly reports, right? There's the financial statements that accountants use, right, which is called GAAP, and then there's financial statements which I care more about, much more about, called non-GAAP, okay, where financial analysts use the non-GAAP numbers to value companies. So non-GAAP does not include non-cash stuff or one-time events, like if a company had to pay a one-time lawsuit that wasn't a massive amount. And we might ignore one-time events as financial analysts over here, as we want to value what earnings might be in the long run using the many financial statements Excel models that I provide my students in my MBA programs. So let me put this aside for now. And what we're going to do is we're going to go and look at the financials again very quickly. Okay, cool. All right, so I'm going to search for the word non-GAAP here. Okay, so non-GAAP. And we can see there's 8 instances of non-GAAP here. It's what people care most about. And if I go to the very top of DoorDash's financial statements, and I go to the top here of Uber's, the first time EBITDA is mentioned, it's mentioned as adjusted EBITDA. of minus $509 million for Uber, and adjusted, the word adjusted EBITDA, of positive $113 million for Doordash. Okay, and I only care about the adjusted number, okay, the non-GAAP number, because when I create my financial statements, I only want to focus on cash stuff, and I only want to focus on stuff that's repeatable every quarter. So I actually prefer non-GAAP a lot because it only includes items that are repeatable and not one-time in nature. So how do we value companies based on this year's or next year's adjusted EBITDA? How do we do this? Well, the best way to explain this and how to value companies that aren't profitable on an earnings basis yet, but are on an EBITDA basis, the best way to explain this is to look at what PE, meaning price earnings ratios, means when valuing companies. Okay, it basically means for every $1 in earnings on the denominator, for every $1 on the denominator, how many times are investors paying for that $1? So a PE of 10 times means that for every $1 an investor sees in earnings, they're going to pay 10 times that $1. And so for the rest of your life, always think of the denominator in a fraction as being the number 1. Okay, this makes it a lot easier to understand. And I'll get back to EBITDA in a second. But what I want to do is I want to talk a little bit more about price earnings. So why would an investor want to pay more than 10 times that $1 in earnings? I mean, they might pay 20 times that $1 in earnings if the company is growing fast, of course. Okay, well, how can we be more precise, Chris? You know, how can we really tell the difference between whether a company should trade at 10 times earnings or 20 times earnings? That's a big difference. Well, here's the best way to understand valuation. So let's go back to our PE of 10 times example. Okay, and I'm introducing a third concept here you can see in yellow, which is earnings growth. Okay, and let me get a little bit more real estate in the slide here. Okay, cool. And I want to introduce the concept of PEG. Okay, at the top there you'll see PEG, P-E-G, and that stands for price earnings divided, stands for price divided by earnings divided by the growth rate, and this is crucial. So in this example, we have a company that's at a price to earnings multiple of 10, and if we divide, So in this example, we have a company that's at a price to earnings multiple of 10. And if we divide this by 10% growth, then this means the PEG multiple here is 1. Okay? And we're going to have this awesome aha moment in a second. So what if earnings growth was only 5%? Well, 10 divided by 5 is 2. So now the PEG multiple is 2. So now the company is actually expensive at a PEG of 2. So it's actually trading at twice its earnings growth rate. So what does all of this mean? And how can I make more money investing in the long run using this PEG thing, Chris? Well, historically, the average stock in the S&P 500 index trades at 15 times earnings, okay? And the average stock in the S&P 500 has earnings that are growing at close to 15%, okay? These are historical numbers. So if we go back to our blackboard here, then we see that the S&P 500, which trades historically at 15 times earnings, so the S&P 500 has a historical PEG ratio of 1. So if one of the S&P 500 components, one of the companies in the index, is growing at 20% earnings, then it should trade at 20 times earnings and a PEG of 1. Now, if a company in the index is growing earnings at 8%, then it should trade at a PE of 8 times. So if this same stock that's growing at 8% here had a PE of 16, then as you can see here, the PEG would be 2. okay? Meaning the stock is potentially overvalued as it's trading at a price earnings multiple that is twice its growth rate. Okay, cool. So put all this stuff here on a yellow sticky Post-it note and store it up here for just a minute, please. Now recall that Doordash has no earnings. They only have EBITDA. So what about using adjusted EBITDA in a valuation multiple since Doordash has positive EBITDA? Sure, we can do this. But don't look at EBITDA. The market doesn't look at EBITDA per share. They don't do that. They just look at total EBITDA. So what I'm going to do now is very quickly, I'm going to change the PE multiple a little bit here so we can use EBITDA. So we know here that the PE multiple means price divided by earnings per share. And that's the exact same thing as this, okay? So it's the same thing, just per share at the bottom there, you see? Great. So we know that price times shares on the numerator means market cap, right? So I'm going to rearrange this formula. Watch this. Okay, it's just math. So, and this is crucial to understand. So earnings per share divided by share, we move to the numerator and multiply by. Okay, so a P multiple is basically price times number of shares divided by earnings. All right, and that's the exact same thing as market cap over earnings. Okay, now let's assume the denominator is no longer earnings, but let's make it something similar to earnings, which is EBITDA. So now what we can do is we can compare a company that does not have earnings, but it does have EBITDA to other companies. And if you want to take this to a step further, we can also talk about enterprise value and EBITDA multiples. So what if a company's current adjusted and non-adjusted EBITDA is negative? What do you do? How do you value a company aside from a price to revenue multiple? Well, what I'm about to say is the simple secret to how long-term investors make a fortune by investing in stocks that appear expensive today. All right, I never overdo anything. Okay, so the answer to how to make a fortune and to value companies that are not profitable yet is on the other side of this Lego brick, which I'm going to show you in a second. So years ago, when I worked in the hedge fund industry, people said, Chris, you're crazy. Why do you own Salesforce, ticker CRM? And why do you own Amazon and LinkedIn when it was public? And why do you own so many expensive stocks? And people would say, Chris, I learned in business school to only buy cheap stocks on a PE basis. Well, I think valuing stocks only based on a low or a high current PE is a recipe for disaster. And it's something that traditional overpriced theoretical MBA programs teach you. So here's the secret. I told those hedge fund rookies years ago that criticized me for owning Amazon, Salesforce, and LinkedIn that no, I don't think the stocks are expensive. And yes, I understand that these stocks are trading at more than 100 times this year's earnings and 100 times next year's earnings. And yes, these companies can stop investing in growth right away and fire their salespeople. And they can also fire their research and development people. And yes, they can get their PE to be very, very low today. But if they do that, then their earnings will never be massive in the future. And so, my simple secret to successful investing, which I teach in my MBA program, is, wait for it, here it comes. Always look at earnings in 10 years, okay? Always look at earnings in 10 years. And then what you do is you take the price of the stock today divided by your earnings estimates in 10 years in order to understand if the stock is materially undervalued today. And I'll show you a very, very quick example. So, how do I value this company that I'm looking at, hypothetically speaking, that can have very, very high earnings in 10 years? Well, if in my Microsoft Excel model for the income statement in 10 years, I come up with earnings per share in year 10 of, say, $50, right? $50 per share. And if I see that between years 9 and 10, based on my income statement forecast, If I see that earnings are growing at 10%, then if I assume a PEG ratio of 1, then my target price in 10 years is $500. Right there, you see it? My target price in 10 years is $500 because a company growing earnings at 10% should easily trade at 10 times earnings, and 10 times 500 or 10 times $50 in earnings gives you a target price here. A lot of moving parts. Gives you a target price of $500. And so valuing companies based on your earnings estimates in 10 years helps you see the bigger picture. And it stops you from committing the biggest sin in investing, which is selling a stock for the sole reason of it's going down. And thinking this way, meaning projecting earnings in 10 years, will actually stop you from just renting or being a tourist in a stock. And also thinking this way, meaning projecting earnings in 10 years, will help you make 5, 10, 15, or 100 times your money, instead of just trying to make only 10 to 20% per year in a highly volatile and very unpredictable market. Thank you.